Drew, let me just kick off with you. And this sounds like your expectation is pretty high for the kind of rating we might get for payrolls Friday.
Oh, I just think there's going to be a weather-related rebound. It's not rocket science. You had a big decline because of the hurricane, and you should expect to see those people going back to work once the hurricane passed and they were able to kind of get their lives sorted out. They could return to work, and so that's a pretty simple equation, I think. And it suggests that you're going to have decent payrolls and sticky inflation to the upside, and that should be a combination, I think, for the Fed to stay on hold in December.
Drew, why do you think it is that we keep hearing from officials saying, they think we should still be cutting, a little bit here and a little bit there? I mean, what is the economic case for trimming rates by another quarter point, either now or a couple more times in the months to come?
I think there's a decent case to be made for a couple more times in the months ahead. If we think about where neutral is, it's probably around 4% for the Fed funds rate. And so we're a little tighter than neutral, but at the same point, we do have sticky inflation to the upside. And we don't have any real signs that the economy is kind of derailing. So the question is, why would you keep cutting rates now? Maybe kind of let the higher rate pressure do its work and maybe try to wring a little more inflation out of the system.
Steve, I'll bring you into that. And we have heard from a number of Fed officials this week. What do you glean?
I'm reminded of a quote from Galadriel in Lord of the Rings where she says, "The quest hangs by a knife's edge." I think that's where we're at right now on this December cut. You had Waller say he was leaning there. If you squint your eyes and look and think carefully about what Tom Barkin from the Richmond Fed told me today, I would say he could be convinced of a rate cut, but it would depend upon the data coming in on Friday and the next inflation report before it. It's very close, and I think what looks most clear is some kind of pause after whatever they do December. If they were to hike, you'd get a cut. You would get a pause in January for sure. And I think the case for the cut, I'd make a couple of them. The first is that the Fed would still be in what it calls a recalibration mode here, where it's not really cutting based upon the data that Drew is talking about. As good as Drew's case may be, it's not necessarily related to that. It's bringing it down off of the highs from when it was fighting inflation of 7% or 9%, depends upon which metric you use, and that now that it's around 2.5%, the Fed is still restrictive and too restrictive given the rate of inflation that remains out there. The second one is to provide some relief. If you, for example, look at the beyond, by the way, the financial markets, if you look at the mortgage rate right now, the mortgage spread to the 10-year has come in while the Fed has been cutting. It was abnormally high, up above 300 basis points. The average, by the way, is like 175 to 200 basis points. So there's the 10-year, 30-year mortgage spread. You can see it's down, call it 270, 260. It was as high as 300. So that would provide some relief to the housing market and home buyers that are out there. As well, of course, as we talked about a lot, Kelly, the notion of small businesses still paying very high rates in the market.
Drew, if you think they might end up skipping in December, should we expect the chair to say as much, whether he says it in a way that everybody understands or at least market participants understand when he talks to Andrew in a little bit?
I think he likes keeping his options open. I mean, if we think about what Steve was just talking about, one of the interesting things is no one's talking about financial conditions anymore. And yet, the right before us, we were talking about how high the equity market's going. So, that doesn't seem like the best idea to be cutting rates into an equity market that just keeps on rising and rising and rising, or you're going to have to worry about financial conditions maybe becoming unhinged or maybe some irrational exuberance if we want to go back to Greenspan. And so, cutting doesn't seem to make sense in that concept. And 25 basis points for the mortgage market just really isn't going to move the needle on housing. So I'm not really sure the argument holds there either. I think what's more important is that they're able to maintain a cutting cycle over the coming months and quarters and get us back down to 4% without having some sort of aberrant inflation number actually spook the market into thinking the Fed's going to have to stop and remain stopped. And I think that's the risk.
Yes, Steve, go ahead.
I'm just wondering, Drew, just so I understand, and it's been a pleasure talking to you over many decades and largely being in agreement. What's your sense of why you're saying the Fed will cut 75 basis points down the road? And if that's the case, how do you argue against the 25 now?
It's really just a matter of timing. Let's maybe hold some ammunition for a time where the economy looks a little weaker. I don't think the economy looks particularly weak right now. For a period of time, we had rising unemployment, and in a rising unemployment environment with sticky inflation, you could make the argument that, cutting rates there made a little bit of sense because you're trying to manage the unemployment rate to a level. But with the unemployment rate remaining pretty stable, it's hard to imagine that we should be cutting rates, in advance of some sort of downturn in either financial conditions or the real economy.
Kelly, if I could just add one thing, which is while Drew's speaking, they're putting up the December 25 funds contract, and that shows the market generally in agreement with Drew right there, right? Which is if you look at that rate at the end, there it is, 379. So somebody do the math for me. That's about 75 or a little bit more below where it is right now. So that's general agreement with what Drew was saying. And I guess what we're having is an argument over timing.